Julie Manning, hello.
Hi, Jean-Baptiste.
It's a pleasure to receive you on BiTV. You're the global head of climate and carbon at LaSalle Investment Management. The ULI and LaSalle IM have recently launched a new tool for real estate investors and other practitioners to evaluate the cost of action or inaction regarding climate risks. Uh, First of all, what are the current best practices used by investors to evaluate that climate risk of their assets?
Yeah, I think this is very much a new and evolving practice for our industry. And I think what we're seeing some convergence on is really thinking about, especially for global firms like LaSalle, really looking at data at a high level, at a global level. We have climate risk data that covers the entire globe that we can access to get a first look at what are some of the climate hazards, such as wind, water, heat, etc., that might be flagged for risk at a particular location. And for example, if we're looking to buy a property in a certain location, we can plug in the coordinates to this database and get a result that says, hey, you may want to look deeper at the flood risk at this asset, for example. In which case we will look deeper with probably using a secondary provider who has more expertise in that particular location or that particular hazard, and really try to understand what is the risk, how resilient is the building to that risk already, what additional resilience measures do we need to be thinking about at that building, and understanding all of that, and ensuring that we've included that understanding in our underwriting so that we're not caught by surprise in the future with economic damages to a building that we weren't anticipating.
Okay, and well, let's delve a bit deeper in that tool. What are the main steps for the flowchart you just released?
Yeah, I mean, I think it's very much similar to what I described. The first step is really evaluate that risk, understand what the data is telling you, understand what the data is not telling you too. Data is never 100% accurate. I like to tell people it is directionally correct most of the time. There are examples where perhaps the data gets it completely wrong. So it's really important to understand that and understand that the human element is really still very important. You need to use your judgment and understand where you may need to spend a little bit more time or maybe less time. The second step, really thinking through kind of how would you underwrite that risk? I think we talked about, does the building already have resilience measures incorporated that we can rely on? Do we need to add more resilience measures to that building as a result of what the data is telling us? How are we including that in our decision making? And then lastly, look at the economics. Does it make sense to invest additional capital in those resilience measures? Do the returns still pencil? And if so, sure, let's proceed on. But sometimes we find that the costs really kind of aren't worth investing in. And I mean, I can give you an example where we were evaluating a potential multifamily building or complex in Florida, whereby the about half of the property was not flagged for flood risk by our data, but we looked at a map and saw a lot of water in and around the entirety of this complex. And so our people, our human element came into play and said, actually, while the data did not really flag high flood risk here, we need to probably take a closer look. And so when we did, we found that actually half of that property, if it were rebuilt today, would need to be built about 1.5 feet higher above ground level than it was when it was originally built, all due to the changes in code, but also, frankly, changes in water levels in this particular area. I would say that is one cost that I don't think we could tolerate, and decided to, with that, in addition to some other factors, we decided to pass on that deal.
Okay, that's a very good example of and practical example of what is what that flow chart, what that set of mind helps you make decisions. And it kind of gives a good jumper for my last question. What is LaSalle's action regarding its portfolio? You started with that example. Is there a general method that you apply, or do you have already that flow chart years back in your processes?
Right. So we're evaluating climate risk now at every step in our investment process. That's starting with our market analysis. It moves on to our individual building analysis as we're doing due diligence on potential new acquisitions, similar to the example I just gave. It moves into our standing assets, the assets that we own today. We're evaluating climate risk on all of them and ensuring that we have proper resilience measures planned for in our budgets and in our asset level business plans. And then lastly, at the portfolio level, we are ensuring that we're evaluating our exposures across the portfolio, really trying to manage through any concentration risks we may have by location, certainly, but also by hazard, and ensuring that we understand what our tolerances are as we're buying new properties.
Julie Manning, thank you a lot for those insight on climate risks.
You're welcome. Happy to speak with you.